The 30-year yield below 3.5%. That has really rallied in the last, a month or so. Joining us now to talk about opportunities in the credit market and what all of this means, Johnny Fine, head of investment grade syndicate at Goldman Sachs. It's a really good day to have you explain some of these moves we're seeing in the bond market. Is this a bet on falling inflation that we're starting to see or rising recession risks?
Well, firstly, Sarah, thanks for having me on again. It's great to see you, especially live and in person.
Yes.
I think the answer is a little bit of both. I think clearly the market is getting religion around inflation expectations coming down, the Fed winning the battle. But I think also at the same time, we're starting to see the market price in a much greater degree of recessionary fear, maybe some of that coming out of the financials conference this week, the bank CEOs speaking. We're certainly seeing a little bit more of that bleed through into markets. I agree with you, the 30-year has been on a tear. It's now down almost 100 basis points in yield from where it was just in late October.
Which was the high.
Yes, exactly.
And so is that, with that, we've seen an inverted yield curve, and it got even more inverted to the most we've seen in decades. What is that telling you?
So the curve has remained pretty inverted. The 10s, 30s curve has now moved back to flat. 2s, 10s, 5s, 30s, et cetera, remain heavily inverted. But at the same time, the front end of the yield curve has come down as well. So I said the 30-year has been down 100 basis points off of the wides. The 2-year note's down about 50 basis points off the highs. The 3-year note's down around 60 basis points off the highs as well. So that's also implying less monetary tightening in the future as well. Market, I think, getting much more comfortable with the Fed's own target of maybe 5.25% there or thereabouts for terminal funds rate early next year.
So what are the conversations you're having with your clients about next year? How would you characterize sentiment, positioning around some of these risks?
So I think overall there's a general view that financial markets have predicted a weaker economic outlook for 2023. The debate will continue to rage as to whether or not we'll get soft landing or we'll really tip into recession perhaps in the second half of next year. I tend to agree with Jan Hatzius's point of view, roughly a 1 in 3 chance that I think that we get a recession. So I'm still optimistic that the Fed's going to land the plane towards the soft landing scenario that I think that we're all hoping for.
I don't know. Your boss, David Solomon, sounds a little more bearish about his views on
now,
recession.
I don't like to disagree with David. I also don't like to disagree with Jan.
Right.
I'm generally a glass half full guy, as you know, Sarah. So I'm going to go with an optimistic scenario of soft landing.
How's the credit market behaving?
Pretty well. I think that over the course of the year, of course, credit spreads have widened. That's largely been driven by more technical factors. This time a year ago, we had almost $300 billion of flows into investment-grade bond funds. Now we have around about $160 billion of outflows year to date. That's a swing of almost $500 billion. That's pretty meaningful in the grand scheme of what we see in investment-grade credit. Now, as you move into 23, I think the fundamentals are going to catch up a little bit. What I think we'll need to look for is that if earnings estimates start to come down, projected earnings, forward earnings, et cetera, then we'll move into the concept of passive leveraging, where ultimately the denominator in the debt over EBITDA ratio will start to decrease, and as a result, the leverage ratio will start to increase.